The digital advertising ecosystem is currently navigating a structural transition from privacy-dependent tracking to algorithmic, AI-driven determinism. This shift was precipitated by Apple's implementation of the Identifier for Advertisers, or IDFA, framework, an event that effectively neutralized traditional mobile marketing yields by restricting cross-app tracking. In the resulting vacuum, a new model has emerged: closed-loop, first-party data ecosystems powered by predictive machine learning. AppLovin has positioned itself at the center of this transition. By controlling the infrastructure where mobile games are published, monetized, and advertised, the company has bypassed the limitations of third-party tracking. Their AXON 2.0 engine functions as a predictive matchmaker within a walled garden, moving the industry standard from user tracking to probabilistic behavioral prediction. This reflects a broader macro trend in which capital deployment in marketing is increasingly automated, with algorithms demanding immediate, measurable return on ad spend at scale. Before this algorithmic shift, mobile advertising was characterized by fragmented capital allocation and systemic inefficiency, a spray-and-pray approach where developers struggled to acquire users profitably. AppLovin addresses this by collapsing the value chain. They operate the supply-side platform, Max, which allows developers to auction ad space, and the demand-side platform, App Discovery, where advertisers purchase that space. By serving simultaneously as the exchange, the auctioneer, and the data broker, AppLovin eliminates wasted ad spend and transforms speculative marketing budgets into mathematical certainties. The company's primary competitive mode is a two-sided liquidity flywheel rooted in data. The Max mediation platform is integrated into thousands of mobile games, processing billions of ad requests and feeding proprietary data into the AXON 2.0 engine. This creates a self-reinforcing cycle. More publishers using Max lead to more data for AXON. Superior data leads to higher ROAS for advertisers. Higher ROAS attracts more capital. And increased capital flow results in higher payouts for publishers, further incentivizing Max adoption. This closed-loop system starves smaller competitors of the data necessary to compete. Furthermore, the structural switching costs are high. AppLovin's software development kits, or SDKs, are embedded deep within a game's codebase, acting as the central nervous system for revenue. Replacing this architecture risks significant revenue degradation and loss of historical yield data. Unless a competitor can provide a guaranteed massive premium on yield, an unlikely scenario given AppLovin's scale, the integration remains permanent. Once AppLovin is in the stack, they effectively own the digital plumbing.
The long-term bull case for AppLovin hinges on the sector-agnostic nature of the AXON engine. While the company currently dominates mobile gaming, it is now pivoting toward the global e-commerce arena. The launch of their self-service e-commerce advertising platform represents a massive expansion of their total addressable market. If the predictive algorithms that powered their success in gaming can be successfully applied to retail and e-commerce, AppLovin will capture an entirely new ecosystem of global demand. This transition would evolve the company from a niche gaming utility into a foundational infrastructure layer for all digital commerce. If AppLovin maintains its current EBITDA margins while doubling its market reach, the existing valuation, a $187 billion market cap with a price-to-earnings ratio in the high 40s, would likely be viewed in retrospect as an undervaluation. The thesis assumes that the mathematical superiority of their matchmaking engine is transferable to physical goods, allowing them to rival the advertising efficiency of platforms like Meta or Alphabet. This expansion would decouple AppLovin's growth from the cyclical nature of the gaming industry, providing a more diversified and robust revenue stream for long-term holders. Despite its dominant position, AppLovin faces several execution and disruption risks. Internally, notable insider selling by directors and the CFO in mid-2026 suggests a degree of skepticism regarding the sustainability of current growth rates at peak multiples. Furthermore, the expansion into e-commerce introduces new friction. Unlike digital game downloads, e-commerce involves physical supply chain constraints, different attribution models, and longer return timelines. If AXON fails to deliver the same elite return on ad spend for physical goods, the company may face inevitable margin compression from overinvestment in this new sector. Externally, the company remains a tenant on platforms owned by Apple and Alphabet. Any draconian shift in operating system-level privacy rules or App Store fee structures could impair data ingestion. Additionally, emerging supply-side disruptors like CloudX are attempting to attract publishers by offering alternative paths with lower friction. If major studios fragment their inventory away from the Max platform to reclaim control, the data-driven moat could begin to erode. From a macro perspective, AppLovin is sensitive to the velocity of consumer spending. In an environment defined by sticky inflation, rising interest rates, and geopolitical volatility, such as US-Iran tensions affecting energy prices, consumer wallets compress. A reduction in spending within mobile games or e-commerce apps leads advertisers to immediately slash budgets. Regulatory pressures also present a headwind. The European Union's Digital Market Acts and US state-level privacy legislation threaten the cross-border flow of behavioral data. For a machine learning engine that requires a constant stream of global interaction to function, the geographic fragmentation of the internet is a serious systemic risk. The rational verdict for the 5 to 10-year outlook remains positive, however, based on the company's financial resilience. AppLovin has built an algorithmic juggernaut with a flawless balance sheet and an insane margin profile. The sheer volume of cash generation provides a significant margin of safety against macro volatility. While the stock trades at a premium PE of approximately 48, the PEG ratio of 0.43 indicates that the growth engine is significantly outstripping its valuation. For a serious investor, AppLovin represents a core compounding holding, a high-octane cash machine suitable for an aggressive growth portfolio. The primary requirement for holding is an understanding of ad tech cyclicality and a belief in the continued mathematical superiority of the AXON engine as it moves beyond gaming and into the broader e-commerce landscape.